Hello fellow traders. 2026 energy risk is driven less by slow supply, demand cycles, and more by geopolitics, checkpoints, and sanctions that can send oil sharply higher in a matter of days. Your portfolio feels those shocks through inflation, higher interest rates, and correlated equity drawdowns, even if you have no direct commodity positions on. We're going to go into building practical hedge framework, looking at ranges in ExxonMobil and Chevron, so that sudden energy spikes become manageable events rather than portfolio killers. By the time the big oil hits your screen, the easy edge is gone. But the point today is to get you out of reaction mode and into preparation mode. I want you to understand how each of these tools behaves, how to combine them, and how to size into them so that you're consciously trading a small, known insurance cost a day for protection, and when the energy hits the tape, it goes vertical. Today we're going to get into the strategic guide and hedging your portfolio against sudden 2026 by Pajama Trader. How an energy shock actually hit your book. An energy shock doesn't just move in the energy sector, it ripples through almost every part of your portfolio. When crude jumps, energy-intensive businesses and transportation see margins squeeze as fuel surge costs faster than they can actually reprice their output. Higher energy prices feed into inflation expectations, which pushes yields higher and compresses valuations in long-duration growth stocks and yield proxy sectors like utilities and REITs. A portfolio that looks diversified on the sector chart can still experience a synchronized drawdown because the same oil shock is hitting both your risk bucket and your safety bucket at the same time. Oil spikes, fuel insets costs explode, and that pressure shows up in inflation data and expectations. The bond market reprices, yields move higher, and suddenly your growth names are selling off along with your utility and dividend names. That's the environment we're planning for. Label-based diversification is not enough. You need specific structures designed to make money when the reaction change starts. Hedge, stack, crude calls, and inverse. Overhedging framework has 3 layers that work together. The first layer is the latter out-of-the-money crude oil calls as liquid WTI or Brent futures pays when oil spikes sharply on supply disruptions or geopolitical surprises. The second layer is an inverse utilities ETF that overlays the benefits when inflation and rates rise, and utilities as rate sensitive yield proxies underperform in response. The third layer is a deliberate liquidity buffer held in cash or short duration instruments, which keeps you from becoming a forced seller and gives you the ability to buy assets that have been marked down aggressively during the shock. When all 3 layers are in place, at least part of your book is designed to win when energy risk turns into the headline. Think of this as a 3-layer shield. The crude calls are tied directly to the commodity. They pay when your oil goes vertical. The inverse utilities position is tied to the macro fallout in rates and yield proxies. The cash tied to your behavior. It is what lets you buy weakness instead of panic selling at the lows. As we go deeper, keep asking yourself, in my own book, how big does each layer need to be for it to actually move my P&L in the shock? Using crude call ladders in practice. Out of the money, crude oil calls give you controlled cost upside exposure to the large, fast moves in oil that matter most for most portfolio risks, rather than trying to trade every small fluctuation. In practice, select expirations with a few months out and build a ladder of strikes above current futures so that moderate moves engage the lower price strike prices, while extreme price spikes activate the higher strikes for outsized payouts. You cap your annual premium and spend at a small percentage of your portfolio value, accepting that the bleed in calm markets in exchange for a meaningful inflow when oil jumps at the exact price or exact time of your other assets that are under pressure. Treat this as insurance with teeth. You're not trying to scalp the $1 move. You're deliberately targeting the big, ugly move that actually hurts your portfolio. For instance, you might allocate 1 or 2% of your account per year to a 3-strike ladder that expires 3 to 6 months out and strikes 10 to 30% above the spot. If the shock never comes, that cost of protection, you just lost. If we do get to a geopolitical event that sends oil to 20 to 30% higher, you will want that ladder to throw off enough profit that you can offset a meaningful piece of your equity drawdown and still have capital to buy into the panic. Trade example. I wanted to go over a couple of investments. So, say if you took your 3 to 500 shares or even 1,000 shares, and say that while it was consolidating in between 89 and 120. So say if you bought it on this bounce here, 98, and then you basically was able to catch this breakout with volume as it's making new highs. Now looking at Chevron, sort of the same thing. Consolidated 112 to about 165. And say if you got in right at 128, then you basically caught this breakout as it's breaking from 150 to 187. And the common thing in both of these is that there's really no overhead resistance as oil's making new highs. And to further add, with the current war going on and the battles in the Strait of Hormuz, means that these gas prices are probably going to go even higher. Now in the scale, this framework down to a $2,000 account, so you can see how the same logic applies with smaller numbers. In this example, you hold out about $300 in the ExxonMobil and $200 in Chevron as your core integrated energy exposure, with the remaining $1,500 spread across other sectors, including around $200 in utilities and dividend type names. To hedge to the smaller book, you commit roughly $40 or 2% of the account to simply WTI, call mini ladder 1 to 3 months out, using small options positions with strikes about 10 to 20% above the current futures. So even a tiny position, they can move your P&L in a sharp oil spike. At the same time, you add approximately $200 of inverse utilities ETF, roughly matching your $200 utility sleeve, so that if an energy-driven inflation shock pushes utilities down 20%, your inverse ETF gained about 20% to help cancel out that loss. Now run this as if you're trading a $2,000 account, which is where a lot of the new traders live at. You put $300 into Exxon, $200 into Chevron, so that 25% of your account sits in the integrated majors that tend to benefit when oil moves higher. You have about $200 in utilities and other yield names that are going to struggle when inflation rates jump after the energy shock. With only $2,000, you can't hedge everything. So you get very intentional. You set $40 to just 2% of the account to buy a small amount of out of money WTI call position 1 to 2 months out. Picking strikes 10 to 20% above the current futures price. Nothing happens, the $40 is your annual insurance costs. But if we get a meaningful geopolitical move that drives oil sharply higher, that tiny option can suddenly be worth a few $100s, which is a big deal in a $2,000 account. At the same time, you put $200 into an inverse utilities ETF to roughly match the $200 utility exposure. If the utilities falls 20% in the shock, you lose $40 on the long utilities, but make about $40 on the inverse ETF. So that slice is the book that's basically hedged. At any upside that you get from Exxon or Chevron as oil rallies. And then you see how often a small account and how things can work out. The crude call giving you a shot at a large percentage gain. The inverse utilities piecing, offsetting rate-driven pain, and your Exxon and Chevron positions benefiting from strong energy economics. The dollars are smaller, but the logic exactly the same for the larger portfolios. Exxon and Chevron as structural beneficiaries and implementing steps. ExxonMobil and Chevron are diversified integrated energy sectors with upstream, midstream, and downstream operations along multiple regions, giving them leverage exposure to higher oil and gas while maintaining a balance sheet through strength and scale, and with smaller products lack. Within this framework, they function as structural beneficiaries of the very risks that we're trying to hedge, providing potential price appreciation and cash returns when energy shocks hit. To implement this full strategy, you start by mapping your own exposures, then define the small annual premium budget for the crude call ladders capped at national for the inverse utilities overlay, and a target liquidity range. With Exxon and Chevron as your core energy winners and your options ETF hedges layered on the top, your portfolio is no longer standing naked in front of the 2026 energy shocks. It is positioned to absorb the impact and use that volatility as an entry point rather than an exit point. I want you to see Exxon and Chevron as built-in winners in this story. When oil breaks higher for geopolitical reasons, their integrated models often turn into better cash flows, stronger dividends, and more flexibility on buybacks and capex. They're not risk-free, but structurally they sit on the right side of the trade. Your homework from this framework is your audit to your own book. How much energy risk are you implicitly short through margins and rate sensitivity? How much can you realistically spend on crude options premium this year? Where should your maximum inverse utilities be? And what is your minimum liquidity floor? Once you write those numbers down, plug in those structures where we discussed. And energy shocks do stop from being an existential threat and becomes a scenario that you can actually have a game plan into. Thanks again for watching.